Yeah, absolutely. I think you saw an interesting market reaction where, immediately everyone was focusing on that vote split for QE, which is obviously unanimous. And we actually had them admitting that actually data has been better than expected in August. So we saw sterling trading higher, but then they significantly highlighted the risk to unemployment from the end of the furlough scheme. So that big kind of fiscal cliff the UK economy is heading for. And then obviously this new addition of almost forward guidance that they're not going to raise rates until there's significant progress in inflation. So we're actually seeing it sterling coming lower and the rates market actually pricing in more of a risk of negative rates within the next year.
That's interesting. So more of a risk of negative rates sooner. You look at the August inflation data that's come through, falling sharply. It did exceed expectations, though. So what does this mean for inflation, the outlook for it, and the probability that we will in fact see them have to go toward negative rates?
Yeah, I think when you look at the Bank of England, they've had a really solid history of kind of looking through those temporary factors. So yes, we had a very important inflation print in August, but it is explained by those VAT cuts when it comes to the hospitality sector. So I do think they will look through those, but definitely on the long term, on that significant output gap that the UK economy is facing and reduced demand, they are going to be extremely worried. And don't forget, of course, that we are facing the end of the UK furlough scheme. And what we know from the data is, that massive drop in average hourly working hours. And what that implies, so many people are still on furlough. And once that furlough scheme comes to an end, we're going to see the real impact of coronavirus, which we just haven't seen yet in the UK.